Morning,
Hi,
morning. Can
Brian. All
everyone
good.
hear me?
Yeah, we can hear you. All good, Brian. Thanks.
Wonderful, wonderful, wonderful. So yeah, without wasting any time, I'd really like to get into the business of today. Um, First of all, I would like to take some few questions, and after taking some few questions, I will start breaking down strategy, so that the new guys can really adjust to what we're doing. So if you have a question, please unmute yourself and shoot your question directly. Keep it brief and straightforward so that we can move on. You can go ahead. All right. If there's no one who has any questions currently, let me go ahead and break down the strategy. So those of you who are new here, we're dealing with the MMC footprint strategy. This strategy is applicable on all the time frames. It doesn't matter which time frame you apply it on. Everywhere it can be very applicable. So with that being said, it doesn't really also matter the kind of pair you're trading, be it Nasdaq, currencies, stocks, literally everything. So give me a second, quick. Right. So what we normally deal with the strategy is that we normally look for this kind of a structure. Pay attention to what I'm about to draw right now. And from there, when we normally look for this kind of a structure, there are lines that we draw on top of the structure. And I'll be drawing the first line. And I'll also be giving it a name. That's the footprint line. The second line, it is called the first layer line, which is the most important line. Now, the aim here is, or what we want to achieve is that we want to wait for the market to break the first layer line, meaning breaking of the first layer line. And after that, we want the retest, but the retest must not be lower than the previous point. If we are buying, why is that? Because of at the end of the day, we want to be able to draw a footprint in an opposite direction. Want to be able to buy in the opposite direction. So now, when the market reaches, after the markets pull back, what we wait for, or what we normally focus on, or the divergence that how we go about spotting the divergence when the market reaches that point. It is this way. Let me try to Let me make an example with this setup. Okay, like I said, after the market breaks there, the first divergence after the breakout, wait for it to go up and pull back so that we can be able to spot divergence. Now, here on this time frame, the 1 hour time frame, the first divergence that I can see with my eyes, I will spot it this way. I will compare the market to the stochastic. So the market is here and the stochastic was there. The stochastic was there where it touched the oversold. After it touched the oversold, go check where the market was when the stochastic was there.
Brian, are you still sharing your screen? I can't see it anymore.
Yes. Is there anyone who cannot share the screen also?
We can see your screen.
Can you see the chart? Can you see what I'm drawing?
We saw the 2 points you drew.
Oh, okay. That means like my guy who just asked, that means try to, I don't know, restart or try to see what's the issue with the app.
Okay, sure.
Sorry, was someone saying something?
I was saying you must just check his connectivity.
Oh, okay. No problem. No problem. Let me continue. Looking at those 2 points, you can see that from this point to that point, it's an ascending movement. From this point to that point, it's a descending movement. So that now the final confirmation, it is done through the crossing over between, you can see the blue line crossing the orange line around here. So immediately after the oversold is crossed, is touched, we just fully confirm with the crossing over. Then after you fully confirm with the crossing over, that's when you will start making your execution. And that execution, you'll be making it there. And from there, what will happen is that the market will go into your direction, as you see that it's happened there. And in order to add more trades, you use the same divergence technique in order to add trades. Going back to the whiteboard, we're going to be buying here. The market will go into your direction. As it continues going to your direction, there will be some retests on the way. As the retests happen, you'll be able to add more trades there then. You'll be able to add more trades. And from there, after you add more trades, like as the market continues going to your direction, from there, if you can be able to find if you can be able to draw your setup, your full setup, whereas you draw, the footprint line, and after that you draw the first layer line. That's what we're looking for, because of at the end of the day, you must know when to actually close the buy trades that you took. So now, in order to determine how to close the buy trade, you must first be able to see or spot the footprint line to show the slope of the market. And after that, you have to spot the first layer line. Now, as we know that the breaking of the first layer line, it is signaling the market to go into the opposite direction. Now, when that is the case, that means any breakout. If we're on if we're on some trades and the market breaks the first layer to the opposite direction of what we're in, that means we must actually pull out of the trade. Meaning here we just simply wait for the breakout. When the market breaks here, all the buy trades we close them. We wait for a pullback. After wait for a pullback, we use the same technique. Look for a sell divergence using your stochastic oscillator. And those who don't know or those who are new, the settings of the stochastic are just 533. Né? So normally on your MetaTrader 4, they are quite default, so you don't need to rechange them or do anything. So from there, you'll be able to enter a sell there using divergence. The market will go into your direction. As it keeps on going, as it keeps on making some retests, you add more trades because of divergence. And then don't try to make a mistake of not being able to draw your footprint and first layer on time while you're on a trade, because you need to know when you should actually pull out. And that can be determined by the breaking of the first layer. And the reason why we rely on the first breaking of the first layer is because of there's no certain amount of pips or a certain amount of profit target in terms of pips we can target, and it can be the same over and over again. So it's all about the market, whatever you can take when such movements happens. So when there's a big movement in the market, we're guaranteed that we'll ride until that big movement comes to an end. When there is a small movement, we'll also be able to ride until that movement ends, because of we know exactly when we should actually start prioritizing to leave a trade. We don't just ride on a trade because of we feel like, okay, we want to ride this trade and it will bring money, but you find that it's a short-term trade, even though it's on a bigger time frame. So the structures differ a lot. So the most important thing is be able to apply your things correctly so that you get notified if there's anything that you should be aware of. So once you've mastered this, like some of you guys who've mastered the strategy, you are able to hit the market going up, going down, meaning you can trade from early in the morning until very late, until even the market closes at the end of the week. Because of once you get one footprint, you know it will lead into another one. And if you keep on, if you keep on going with it, then you'll get a full understanding. It is not necessary, like sometimes, to just focus on different pairs. You can even trade one, but you can decide to trade Nasdaq the entire day or the entire week or the entire month. And it can also be very much easier because you saw its movement before. You saw the first footprint that you saw, and from there it gave you the second footprint. After the second, it gave you the third footprint from where you started. And from there, you have a track record of where this time frame is coming from. And even if you can go into a bigger time frame and be able to break that down using the same, you will still get the same answers. So like prioritize keeping it simple. Don't overcomplicate the strategy. There's no need. Otherwise, you make yourself go crazy over things you should not be even going crazy for. Like, and yeah, from there, let me finish this example. As you made a trade there, wait for the breakout. After the breakout, you know it's time to pull out and go to the opposite direction from there. So now let's go and implement this on the chart. So like I said, it doesn't matter which time frame. Let's try US 30. Which time frame? We can even try 5 minutes and see what we're looking at. I mean, the market has been very good here because it has been given. I'm seeing a lot of hints here for sell, for both sell, for both buyers. Because someone could consider this as a footprint or consider that as a first layer. And simply what would have happened is that immediately after the breakout, spot the first divergence. So right now, I'm on 5 minutes. I'm not seeing any proper divergence. Let's check 15 minutes. Proper divergence was not there. So that means we're dealing with the crossing overs. 1 minute there's no way there isn't. So yeah, 1 minute there's no way there wasn't. So in this case, what you normally do, I'm gonna draw a horizontal line. I mean a vertical line. So you're using, and from that vertical line, what you do, you confirm was 5 minutes. Even though there is a full clear divergence, the same technique works. And yeah, after the crossing over there, it decides to sell there. Or some will say, okay, you see the market was here, the stochastic was there on 15 minutes, meaning it was saying, okay, we should go down. But after that, there was a crossing over to the upside. As there was a crossing over to the upside, some can wait for the crossing over to the downside so that they can be able to sell it. But if you would have sold around here, eventually you will see profit. And the same thing also happened. The footprint, after the footprint, there was a trade that is even happening now. First layer, after the market breaks the first layer on 5 minutes, you would have entered very late. 1 minute again. 1 minute doesn't have major pullbacks, so you can get away with it. You won't mind if the market consolidates. So the first divergence from here, where the market touches the overbought, it is between here and here. No, it doesn't make sense. This line is the only horizontal line. So it doesn't make sense to connect it with that one. Let's check for the second thing. Yeah, this can work around from here to there. From here to there. And yeah, from there the trade is placed. Placed there. So now already in profit. So as the market keeps on going up, we'll use this as our footprint. Simple as that. So check NASDAQ. Check what has been happening here. Comparing only just 2 points. Some could have used that one as a footprint. Some could have used that one as a first layer. And which gave, let's check 30 minutes. It might give us a proper one. Some could have used this one, that point to that point. And took a sell there. So, and even if we go into a minor detail form, NASDAQ can be easily traded like also in 1 minute, where you don't have to give yourself a lot of headache. But when you trade it on 1 minute, find the structures that are equivalent to 1 minute. You cannot trade on 1 minute and unzoom your chart and analyze something very big. It doesn't help. So it's better if you analyze 1 minute structure based on 1 minute. That way it becomes very much easier. So as the market kept on going down, it gave hints of what is actually happening. And you find sometimes when you draw this, saying you're drawing the footprint, and eventually the market just break even the footprint that you drew without even forming the first layer. It is fine. It's not a problem. It shows that the market is in the rush. So you just need to hop in very quickly. So yeah. And to show how this strategy is formulated, just think in your mind each and every time the market makes a U-turn or the market turns, just be able to spot the last 2 points. The last 2 points are on an incline always. Doesn't matter where the market has turned, like there's always a footprint because doesn't matter how small or big it is, there's always 2 points. 1, 2. Even if it's here, going a little bit down, it's 1, 2. Doesn't matter like how big or small is it, everywhere where the market is turning. 1, 2. Like it, and doesn't matter how big or small it is, there's always the turn. You can use this one, you can use this one, everything. And I want to show you guys something. When the market is, sometimes it is not turning. Let me see how can I explain this. Okay. So you see in the situations like that, and even the market went even beyond that, that's when you know that, okay, here the market, it is not buying because of, okay, I'm trying to find a way to put this together. So when you're on a sell trade, or when you're looking on a sell setup or a sell trend, what needs to happen is that points to point that are underneath, they are moving in a way that it shows that they're on a sell, unless there's a point that is higher than the previous point of the trend. That's when we know that, okay, there might be the market is focusing on the other direction. So it shows some sort of a cup here to show that there is a turn. So that's what I was trying to illustrate here. Or what, to make it easy, see the market as some form of, every time where the market turns, use 3 points. First point, second point, and third point. Know that there is a first point here, second point there, third point here. Sometimes it doesn't matter the sizes. The sizes of, because sometimes you find that this part is very big. You find that this is what is actually happening. And this one actually forms here. So you must be, but at the end of the day, this first 2 points, they are always there. And the reason why I implemented this strategy, because of, we want to focus only on this set point. Only on this set point, because we're truly convinced by this movement that we're about to go into the opposite direction. Now we want to be able to, the first step of going into the opposite direction, it is if you can be able to enter there. So that's why you can be able, with the footprint, you can be able to ride a full trend until the end. So that's how the strategy was formulated. I was looking at how the market moves in this way, and let me show you. Just like in this case, you see the market turned, but how it turned, it might be confusing. But at the end of the day, these first 2 points, they mean something. Don't take them for granted. Even here, first 2 points, they mean something. Everywhere where the market turns. So now if you view the market in this way and structure a line and name it a footprint line that accommodate those things, those 2 things, then that means you are covering the full trend of each and every movement, regardless of the time frame and everything. So you could, this way you have full control of the market, or you know when exactly the market it is turning. So I hope this makes sense. And again, like as you've seen, guys, I've started to find